Chapter 3, Interest Rates and Security Valuation. We're now going to take a look at basic equity valuation models. As with any model for valuing a marketable security, we need to find the present value of future cash flows. With bonds, the future cash flows were clearly defined in terms of a face value and annual coupons. To value a bond, we simply needed to estimate our required rate of return and used that to determine the security's fair value. Equity valuation is more difficult because we need to estimate not only required rates of return, which are a function of risk, but we also need to estimate future cash flows. Let's take a look first at the simplest equity valuation, and that would be a valuation model for valuing preferred stock that has a constant dividend. The present value of that share of common stock, or rather preferred stock, is simply the dividend divided by our required rate of return. If the Marshall Corporation preferred stock pays a $14 per share annual dividend and investors require a 10% return, then we use our simple perpetuity valuation model and find the value of the preferred stock at $140 per share, which is the $14 annual dividend divided by the required rate of return. Valuing common stock is more challenging because there's no constant cash flow in the future. We're going to need to estimate future dividends. One of two ways we can do this. We can try to estimate current dividends going out many years into the future, or we can make some simplifying assumptions. The simplest model is what we call the constant growth model. We assume dividends will grow at a constant rate in the future, in which case the sum of all future cash flows or dividends can be condensed to the simple formula D1 over R0 minus G. Again, the price at time t or price at time 0 would be the dividend at time 1, period in the future, divided by our required rate of return minus our estimated growth rate. Financial analysts had forecast L Brand's growth for future to be 12%. LB's most recent dividend was $1.50. What's the fair present value of L Brand stock if investors require a 5.6% rate of return? First, to find the price at time 0, we need the dividend at time 1. So we'll take our current dividend of $1.50 per share and multiply it by the 12% growth rate. So we're expecting dividends next year of $1.68. And of course, our underlying assumption is they will continue to grow at that 12% rate in perpetuity. If we're not willing to make that assumption, we can't use our constant growth model, and we'll have to use more difficult stock valuation models. So we've got the D1 dividend. The price today then is simply that $1.68 dividend divided by the required rate of return of 15.6% minus our expected 12% growth rate. So we estimate a fair value or a price for the stock at $46.67. Of course, this isn't a very accurate valuation. However, if the stock was selling for $10, we would say no. We would say yes, I think it's a great buy. If currently it's selling for 10 and we think it's worth 46, we would definitely buy. On the other hand, if the price was currently selling for stock was currently selling for 80 and we came up with a $46 valuation, we would probably pass. From a theoretical perspective, if it's selling for $46.60 and we think it's worth $46.67, we should buy. But given the rough guesstimates going into our model, I would be hesitant to buy on such a small price differential. A stock we're evaluating just paid an annual dividend of $3.80. Dividends have grown at a constant rate of 1.6% over the last 15 years, and we expect that annual rate to continue. And if we require a 13.9% rate of return, what would we estimate as the stock's fair value? Again, the first step is to estimate our dividend at time 1 if we're going to be using our constant growth model. And our dividend at time 1 is simply going to be that $3.80 multiplied by 1.016. That's our 1.6% growth rate. Then we can solve for our estimated current stock price by taking that $3.86 dividend divided by R minus G, and we get an estimated stock value of $31.39. What would the fair value be of that stock 4 years from today? To estimate the value in 4 years, in other words, the price at time 4, we're going to need the estimated dividend in 5 years. To get the dividend at time 5, we simply take the time 0 current dividend, multiply it by 1 plus our estimated growth rate to the 5th power. So we get an estimated time 5 dividend of $4.11388. Then we can simply solve for the stock price by taking that dividend at time 5, dividing by R minus G, and we get a price at time 4. We have an estimated price of $33.47. Notice if we were to take today's stock price of $31.389, multiply it by 1 plus our growth rate to whatever number of periods we want to compound it, which in this case was 4 years, we would get our current stock price. And so this shows we can expect our stock price to grow at the growth rate of dividends. And if we do a little bit of algebra, we can rearrange our constant growth formula to find our required rate of return equals a dividend yield plus an expected capital gains growth rate.